It's well known that most accredited investors are overexposed to Wall Street. So today I'm going to show you how private debt funds can create diversification, predictable cash flow without tenants, toilets, or headaches. So first things first, what is a debt fund? What's a private debt fund? Well, it's where investors come together and they invest in debt. And ultimately, just like a bank, it looks and feels a lot like a bank, investing in first mortgage lien positions. Loans are secured by real estate with proper underwriting criteria. And the benefit of a fund versus individual loans, for example, would be that you get diversification across multiple properties and across multiple borrowers. So we reduce that concentration risk. Accredited investors oftentimes prefer debt funds because it can create very steady, very predictable income. Income, depending on the fund, is typically paid out either quarterly or in some cases monthly. And there's lower volatility. It doesn't follow like the stock market, interest rates ebbing and flowing, or the latest and greatest thing that any president might say. Just doesn't affect the debt fund, underlying debt, like it does the stock market, for example. Debt versus equity. I get this question a lot is how does it line up? And how is it materially different if you think about it? Well, in this case, you're a bank, but often you're acting like a bank in the debt fund. So it's first in line to get paid. That debt gets paid first. And when structured correctly inside of a hard money debt fund, is that the returns can look like equity returns, but have the risk of debt. So said differently, lower risk, higher returns versus equity, which is oftentimes higher risk and it should be higher returns, but oftentimes those kind of equate. I mean, the return that you get is offset by the risk that you take. You often end up with appreciation in the equity side of things versus income on the debt side. So what to look for if you were to look for a debt fund? Well, you want to underwrite the operator, of course, of the debt fund. And then you know understand what kind of collateral is going into that. How is it underwritten? What geographic exposure do you have? Because the coasts don't look the same as the Midwest, for example. But if done properly, you can end up with very, very significant returns, double-digit returns, without taking that much risk for it. So private debt funds, they're ultimately about consistency, not speculation. If you want to learn more about how we do things here, I dropped a link below so you can watch a little video there.